Hey everyone, welcome future market experts. You are tuning into your ultimate exam preparation masterclass for NISM Series XV Chapter 2. I am absolutely thrilled to be your guide through this explainer today. We are going to be breaking down the complexities of the securities market into really clear, highly memorable concepts. So if you want to completely ace this chapter, you are exactly where you need to be. Let's dive right in. Here is our game plan for today. We'll start with the basics of the securities market, move into equity, debt, and indices, and then check out funds and hybrid instruments. After that, we'll look at investing in commodities, the primary market, and finally, the secondary market and its participants. All right, let's kick things off with Section 1, the basics of the securities market. To really understand this, we have to map out how funds actually flow, because that is the entire purpose of the financial market. On one side, we have surplus income units. Think of households or highly profitable businesses that just have idle savings sitting around. On the other side, we have deficit income units. These are your governments and businesses that desperately need that capital to grow. The securities market is literally the crucial bridge connecting the two. Oh, and here's a massive tip for your exam. The strict legal definition of what actually makes up these securities comes directly from Section 2H of the Securities Contracts Regulation Act, or SCRA, of 1956. You definitely want to lock that section number in your memory. Moving right along to Section 2, equity, debt, and indices. We're branching out into the specific types of securities now. First up is good old equity. Think of a massive corporate pie. When you buy an equity share, you aren't just buying a piece of paper. You are buying a tiny fractional slice of that pie. You're an owner. And as an owner, sure, you take on the risks if the business struggles, but you also get to reap the magnificent rewards if it succeeds. It's true, literal ownership. On the flip side of that, we have debentures and bonds. Now, this isn't ownership at all. This is a loan. You are the lender and the company is the borrower. For the exam, you absolutely must know the convertibility features here. Fully convertible debentures, or FCDs, turn entirely into equity shares later on. Partly convertible debentures, or PCDs, mean only a portion turns into equity while the rest stays as debt. And non-convertible debentures, or NCDs, well, they are pure debt. They just get repaid on maturity without ever becoming equity. Okay, pay very close attention here, because understanding international debt is highly testable. Let's contrast these two. A foreign bond is issued in a foreign country using that country's local currency. Makes sense, right? But a Eurobond is issued in a foreign country in a currency that is different from that local currency. It actually has absolutely nothing to do with Europe. And here is your golden takeaway for the test. Masala bonds are actually Eurobonds. Why? Because they are issued outside India, but they're denominated in Indian rupees. Next up, we have warrants. The absolute most important words you need to remember here are right, but not the obligation. A warrant basically gives you a superpower. It gives you the right to buy equity shares at a fixed price in the future. So if the market price suddenly skyrockets, you exercise your right and buy them cheap. But if the market crashes, you just walk away. You have zero obligation to actually buy them. Now, you might be wondering, how do we actually know if the market as a whole is having a good day or a bad day? Well, we use indices. Think of an index like a thermometer for the stock market. The Nifty 50 tracks the 50 most representative stocks on the NSE, while the Sensex tracks 30 on the BSE, both based on market capitalization. These indices act as a barometer for the entire economy, and they serve as the ultimate benchmark to see if a mutual fund manager is actually doing a good job. Let's take a quick mental breather and jump into Section 3, funds and hybrid instruments. So mutual funds pool money from a bunch of investors, but you really need to know the structural differences for the exam. Open-ended funds are incredibly flexible. You can buy or sell units anytime directly with the fund at the net asset value, or NAV. Closed-ended funds are a totally different story. They have a fixed unit capital and a fixed maturity. To buy or sell them after the initial offer, you actually have to trade them on the stock exchange where they are mandatorily listed. And this leads us to a brilliant evolution in finance, the exchange-traded fund, or ETF. An ETF takes that fantastic diversification of a mutual fund and marries it directly to the real-time, tick-by-tick trading of an equity share. It's like the best of both worlds. You can buy or sell even a single unit of a whole index or a commodity right there on the stock exchange during regular trading hours. Sometimes, though, pure debt or pure equity just isn't enough. That's where hybrids enter the chat. First, preference shares.
These act a lot like equity, but they get priority for dividends, kind of like being a VIP in the payment line. Next, we have some fun acronyms. FCCBs are foreign currency bonds that convert to equity. ELDs or CLDs actually link your debt returns to the stock or gold market. And finally, please burn REITs and INVITs into your memory. These are real estate and infrastructure trusts. The absolute critical rule you need to know here is that they must distribute at least 90% of their cash flows back to the unit holders. That's a huge exam point.
What if you want to easily invest in a foreign company, but you don't want to go through the headache of opening foreign brokerage accounts? Enter depository receipts. Basically, a domestic bank holds the foreign shares and issues a receipt to local investors. American depository receipts, or ADRs, are traded in the USA. Global depository receipts, or GDRs, are traded in multiple countries, usually across Europe. And IDRs? Well, that's when a non-Indian company, say someone like Standard Chartered Bank, issues receipts that are traded right here in the Indian market. Okay, let's pause for a second and test your focus. Based on what we literally just learned about external bonds, if an Indian company issues a bond in Germany, but it's denominated in Japanese yen, what is it called? Got your answer? It's a euro bond. Remember, because it's issued in a foreign country in a currency that is not the local currency of that country. Excellent work if you nailed that one. All right, Section 4, investing in commodities. Let's shift our focus from paper assets to the real physical stuff. So commodities are your basic interchangeable materials. Think of hard commodities like gold or soft commodities like grain. Now, the biggest hurdle with physical commodities is obviously storage cost. I mean, you can't exactly store a ton of wheat in your living room. That is exactly why precious metals are so popular. They have high value and relatively low storage cost. But honestly, what's even better? Commodity ETFs. You get all the price movements of gold without actually needing a physical safe. You can also use managed futures for active professional management, or you can trade negotiable warehouse receipts. These basically act as proof of ownership for goods that are safely locked away in a warehouse somewhere. Moving on to Section 5, the primary market. I want you to visualize this as a massive factory where brand new securities are manufactured and then sold for the very first time. Let's look at the catalog of this factory. For the general public, an IPO is a company's very first time selling shares, while an FPO is a follow-on offer by a company that is already listed. For the big institutions, we have private placements, like a QIP, which is basically a bulk sale limited to a maximum of just 50 investors. Now listen closely for the exam. A rights issue asks existing shareholders to pay for discounted shares. But a bonus issue? That gives existing shareholders shares completely for free. Finally, an offer for sale, or OFS, is just the existing promoters selling their own shares to the public, and ESOPs are used as sweet rewards for hardworking employees. And that brings us to Section 6, secondary market and participants. Once those securities leave the factory, where exactly do they go? To the secondary market. Think of this as a massive, bustling financial supermarket or a giant sabzi mandi, where already issued goods are actively traded back and forth between investors. Keep in mind, the issuing company doesn't get a single dime of new money here. Now, this secondary market operates in two very distinct segments. On the left, we have the over-the-counter, or OTC market. This is just a direct one-on-one negotiation between two parties. The catch? Counterparty risk. If the other guy suddenly defaults, you are in serious trouble. On the right, we have the exchange-traded market. This is formal, it's electronic, and most importantly, it uses a clearing corporation that guarantees the settlement. That totally eliminates that terrifying direct counterparty risk. Let's quickly trace the life cycle of a secondary market trade. First up is trading, which is just matching the buyer and seller electronically. Next is clearing and settlement. This is where that clearing corporation steps in as the middleman to figure out exactly who owes what, making sure shares and money exchange hands flawlessly. To manage the massive risk of guaranteeing all these trades, the clearing corporation demands margins. Think of an initial upfront margin before you can even trade, and, very importantly, mark-to-market margins to cover daily notional losses. The key players running this whole show are the stock exchanges and the depositories, who hold your shares safely in electronic DMAT form. Wow, we have covered an immense amount of ground today. Let's lock in the absolute core takeaways so you are fully prepared for your exam. Securities are tradable financial claims. The eternal debate. Equity means ownership with both risk and reward, while debt is simply a loan with predetermined returns. The primary market is your factory. It issues fresh securities to raise capital. And the secondary market is your exchange platform. It provides liquidity by letting you trade those already existing securities. Keep this table clearly pictured in your mind and you'll do great. And just like that, it's a wrap on this explainer. Massive congratulations on mastering Part 1 of NISM Chapter 2. You now have a truly rock-solid foundation of the entire financial ecosystem. But before we go, I want you to think about this. In a world where literally millions of shares trade hands in mere microseconds, how exactly is your ownership secured electronically, and who guards the gates? Well, we are going to uncover all of that in Chapter 2, Part 2, coming up next. Stay focused, keep reviewing those notes, and I will see you in the next explainer.